I want to generate 20,000 rupees per month regular income. How do I plan for it? This is most frequently asked question by my friends and my relatives, and my natural response to that question is that you need to invest in those assets that generate cash. Very, very simple. So the natural question is, which are those assets that generate regular cash for you? And what is the risk associated with those assets? So in this video, I'm going to speak about 5 such assets that generate regular cash for you. And also I will speak about the risk associated with those assets. If you're new to my channel, please do not subscribe to my channel. Watch this content for a few minutes. And if you think you are gaining some new knowledge, learning something new, become a lifelong subscriber for my channel. With that, let's get this video cracking. So asset number 1 is stocks. Yes, by building a stock portfolio, you can generate regular cash flow for yourself. This is because a lot of stocks give dividends very, very regularly, almost on quarterly basis. For example, have a look at this screen, and what you see is this is my dividend income for 24-25. The amount you see here is the total 1,45,000 rupees. Now I know this is not a huge dividend income in a year, but I consciously chose not to build a dividend portfolio because I did not need a cash flow coming my way. But if you want regular cash coming your way, you can build a dividend stock portfolio. By the way, I've hidden the names of these stocks here because I really do not want you to get influenced by what stocks I am holding. That is not the intention here. Intention here is to teach you and actually give you live example of people generating dividend. This is my example, 1,45,000 rupees last year. But a better example will be Warren Buffett, because if you see this article here, what is it saying? That in 2025, his dividend income is going to be more than $3 billion. He's built this portfolio over decades, and now this is generating huge dividends for him while he doesn't need to do much about this portfolio. So the natural question comes is that, Rahul, how do I go about building a dividend stock portfolio? So what I've done is I've created this video very, very recently, just 4 to 5 months back. And this video will tell you how to go about picking dividend stocks, right? What are some of the gotchas? What are some of the good things that you need to know about dividend stocks? This video has been watched by 4 lakh plus people. So I'm confident that you are also going to learn if you watch this video. I'm not going to repeat all of that content here. Point remains same, that if you want to generate cash for yourself, look at dividend stocks. That is a very, very good way of generating cash for yourself. However, please make sure you also understand the risk that comes with the dividend stocks. Let me give you a very, very simple example of the risk. Let us say that you build a dividend stock portfolio of 100 rupees today, and every year you're getting, let's say, 8 rupees of dividend back, which is almost 8% of dividend yield. Happy days. Fast forward to 5 years down the line, let us say that 2 possibilities exist. Possibility number 1 is that this 100 rupees that you invested, it might go to, let's say, 200 rupees. That's possible because of the price appreciation in the dividend stocks. Possibility number 2 could be that this 100 rupees might come down to, let's say, 50 rupees. So this is where the risk comes, that the capital that you've invested, it's not guaranteed that it will continue to grow. It is entirely possible that the stock price might come down, and therefore you might see that there is a capital loss for you. However, also understand that a capital loss is not a loss until you go and sell that particular stock. Okay, just because your P&L is in negative, it does not mean that you are in loss. The loss comes when you book the loss. Okay, please understand that important point as well. But inherently, this is the risk that you are taking if you are investing into dividend stocks that generate cash for yourself. One of the great way to mitigate this risk to a great degree is picking the dividend stocks when the price of the dividend stock is not all-time high. In fact, it is below the median price level. That gives you some comfort, that gives you some confidence. Again, all of these concepts I've spoken about in this particular video. Please go and watch this video, and I'm pretty sure you're going to gain a ton of knowledge. With that, let's move to asset number 2 now. Asset number 2 is corporate bonds. Corporate bonds is something that traditionally Indians were not investing at all. Why? Because of the ticket size. But recently in 2024, SEBI reduced the ticket size or the face value of corporate bonds, and it came down to 10,000 rupees per unit. This has made corporate bonds accessible to people like you and me, because if we have a low ticket size, we can still go and invest in corporate bonds. So how do corporate bonds generate cash, regular cash? Let me show you with a live example. So for this, I am heading to Wintwealth, an online bond platform. And right now, if you see on this platform, there are 23 corporate bonds that are live. Again, depending on when you're watching this video, this number may be very, very different. Now, let me pick one of these examples so that you can understand how it generates regular cash. For example, let me pick the first one here. And if I click on it, what you will note is that if you invest in this bond, let's say if you buy hypothetically 1 unit, then your investment will be 999 rupees, roughly 1000 rupees, right? And what you note here is that this bond will give you every month interest. So the monthly payment is what you can expect from this bond. So if you click on view more, what you will note here is that it is showing you how much you are going to get every single month. 24th of September, you're going to get 8 rupees 62 paisa, and so on and so forth. You can see this entire schedule here. The bond matures, let's say, in 8 months of time. Now, if you see the calculations here, hypothetically, if you're buying 1 unit for 999.93, you are getting around 1067.57 rupees back. And in bonds terminologies, this is called yield to maturity, which comes out to be 11.25% per annum. This is annually. Of course, your returns, you are only getting it for 8 months, so that you need to adjust. But the point is that this is how corporate bonds can generate regular cash flow for you if you want to get regular cash flow. Now, the beauty of corporate bonds nowadays is that they are very, very flexible instrument. For example, if you only want to invest for 3 months or 8 months or 14 months, those options are there. Secondly, if you want to get your cash flow on a monthly basis, you can select those bonds. If you don't want monthly, if you want quarterly or annually, those options also exist. Lastly, the minimum ticket size nowadays, you can see here, is quite low as 1000 rupees. So even if you have never tried corporate bonds in your life, you can always start with a very, very low ticket size. Having said this, corporate bonds, you need to really understand how do they work, how do you go about picking these bonds, because there are a lot of corporate bonds. How do you go and make the selection? So to make it all simple, I had created 2 videos on our channel. You can go and watch those videos. In those 2 videos, I've explained concepts such as YTM, coupon rate. There are a lot of concepts that I have taught you. Also, I've talked about how to go about selecting the bonds or filtering the bonds as per your needs. So please go and watch these 2 videos and you're going to learn a lot, and you might be able to easily select and navigate through the corporate bonds. Now, there are various online bond platforms that you can go and explore. I personally like Wintwealth. Why? Simply because they themselves invest 2% in the bonds that they get listed on the Wintwealth platform. And that gives me some confidence and comfort that they have done some due diligence before they're bringing the bond on their platform. And that's why I'm also an investor in Wintwealth. And as I said earlier, if you want to learn more about corporate bonds, I've created these 2 videos. Please go and watch that. You are going to understand a bit more deeper about the corporate bonds. With that, let's move to asset number 3. So far, if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content to you at 0 cost. With that, let's move to asset number 3, which is IDCW mutual fund. What is this new Bimari, IDCW? This is not a Bimari, first of all. And secondly, this is not something new. It has existed for a long, long time. 4 or 5 years back, these used to be called dividend plans or dividend mutual funds. Basically, mutual funds that give out dividends on a regular basis. Let me now clarify this with a simple example. There are 2 types of mutual funds. So for example, if I go to Coin app, and for example here, let's say I'm looking for mid-cap mutual funds. What you note here is that in the mid-cap category, you see 2 options. For example, Kotak, this is just an example, is giving you mid-cap fund, which is a growth type. Second one is IDCW. Now, what's the difference between growth and IDCW? Let's assume that today you buy growth mutual funds, okay? And the NAV is 100 rupees. After 2 years, the NAV of the mutual fund has gone to 120 rupees, meaning that there is a 20% appreciation in the last 2 years. Now, if you want to redeem some units because you want some money back, let's say you redeem your units and you get 20% back. Of course, you pay taxes, etc. But in the entire 2 years period, you did not get any money back. Only when you redeemed it after 2 years, you got your money back, right? This is called growth option. Here, whatever profit the mutual fund manager is making on your behalf, it remains within the mutual fund house and the NAV of the fund continues to grow. That's why these are called growth mutual funds. Comes the second category, which is IDCW, which is income distribution cum capital withdrawal. Simple, meaning that they are going to give you regular cash flow as they make money out of the market. And typically there are a few hybrid mutual funds that generate regular income, regular cash for their unit holders. Let me give you one example so that I can bring it to life. For example, if you go and have a look at HDFC Balanced Advantage Fund, this is a hybrid aggressive fund. And if you come down here and if you just look at their dividend history here, what you note here is that almost every month they are giving dividend of around 0.64% here, 0.63, 0.64, 0.64 again. So almost every single month they are giving 0.64%. If you do some maths, for 12 months, around 7 to 8% of dividend is what they have been giving. Now this dividend, which is around 7 to 8% every year, is not a guaranteed dividend. Please understand this also, right? It really depends on how much return this hybrid mutual fund is making. Therefore, whatever returns they're making, they're going to distribute it as dividends. Now, if they make 10% returns, they might give you slightly higher dividend. If they make 5% return, they might give you slightly lower dividend. So dividends are not guaranteed or confirmed, but typically, if you look at the track record of these hybrid mutual funds, for example, HDFC one here, again, not a recommendation, but if you look at the track record, you will see that their intention is that if they make money, they are going to give the dividends back to the unit holders. And this dividend will vary. Why? Because if I show you their portfolio construct, for example, here, if you see around 65% of this money they have parked in equity and remaining 27% in debt. Now, debt typically gives you very, very stable returns, 6%, 7%, depending on the debt instrument. But when it comes to equity, that really depends on a lot of other factors. How's the stock market doing, right? So, for example, if this 60% of their portfolio all of a sudden is in a bull run and it generates 20% of returns in a particular year, they might give you better dividends. But if you have another year where the stock market is down and therefore the returns are only 5 to 6%, they might give you less dividends. So please understand that it's not guaranteed, but the track record will tell you whether you should go and invest in that particular hybrid mutual fund or not. But this is one of the great way to generate regular cash. Within the IDCW, there are options as well, whether you want monthly, quarterly, semi-annually. So you have that choice as well. My suggestion always has been that go with a reputed AMC, which has got a track record of giving out the dividends or the cash, so that you are not disappointed and you are getting that consistent cash flow back into your pocket. Before I move to asset number 4, if you want to learn various assets, you can consider joining my YouTube community. Almost on a daily basis, I speak about various assets, for example, stocks, mutual funds, and many other ETFs, etc., so that you practically learn. I bring a lot of market insights on this community. The feedback of this community has been very, very good. Simply go to my channel, find the join button and be my guest. With that, let's move to asset number 4, which is commercial real estate. And here some interesting data point for you to understand. First of all, HNIs, high net worth investors in India, are now moving to commercial real estate. Why? Simply because the rental yield in commercial real estate could be anywhere between 6 to 10%. And that's why after stocks or the equities, commercial real estate has become number 2 choice for HNIs. So where are they investing? So have a look at this screen, and what you see here is that mainly industrial and warehousing. If you see the growth between 24 number and 25, almost 5 times growth in terms of investments by HNIs in the industrial and warehousing sort of a real estate. Warehousing simply is needed mainly for the e-commerce shipments, and industrial, it is primarily for the global capability centers, GCC, that a lot of global companies are setting up in India. If you look at the rental yields, it could again vary from location to location, but on an aggregate level, it could be anywhere between 7 to 10% of rental yield that is possible in commercial real estate. So if you're looking to invest in properties and you're thinking that I'll buy a residential property and get some rent out of it, think twice and also explore commercial real estate. Again, depending on the ticket size, whether you may be able to afford or not, this is a big limitation when it comes to commercial real estate, that the ticket size is huge. Even if, for example, if you go to AIF route, which is the alternative investment funds, there the minimum investment amount typically is 1 crore rupees. So the ticket size is very, very high in commercial real estate. Again, if you can't afford it, then this asset class is not for you. This is mainly for rich people. Rich is getting richer. Why? Because they're able to rotate their money under various assets. They can put this money. They are the ones who can buy these assets. Possibly not every retail investor can buy these assets. And therefore, this becomes the limitation of commercial real estate. But at least you get this trend that right now, people are investing more in the commercial real estate in India. So asset number 5 is REITs, which is Real Estate Investment Trust. Although I have never invested in REITs, I'm exploring this asset class further, but it is suitable for those people who want to invest in real estate but have a low ticket size. This generates regular cash for investor, and that's what they are looking for. For example, if I give you an example of Embassy Office Parks REIT, which is one of the oldest one. Again, this is not a recommendation. This is just an example so that you get the concepts right. What you note here is that the dividend trend that they have been giving out. In the month of July, they gave 3 dividends. In the month of April, they gave 3 dividends. In January as well, they gave 4 times dividends, right? So if you sum it up in a particular year, how much of dividend they gave. So let me show you that data as well. So here, if you see in FY25, they gave around 23 rupees of dividend per unit. Now, how much is the dividend yield here or the returns that you can expect? So that depends on the price at which you are holding the REITs. For example, if I show you the price in the last 3 years, somebody who bought this REIT maybe at, let's say, at around 291 rupees level, and if they got 23 rupees of dividend, it comes out to be around 23 rupees divided by 291. So that's around 8% dividend. Another investor who might got it at a higher price, let's say 395 or 400 rupees, for them dividend yield will be low because they've got it at a higher price. So depending on the price, your dividend yield may vary from other investors, but typically these REITs are giving regular cash flow to people. That's why people are investing in these REITs. Now, this 23 rupees of dividend I talked about was only given in last 1 year. What about the long-term history? So here is some data for you. If you look at the last 6 years of highlights of Embassy REIT, I think since the time of the inception for this REIT, they have given around 10.5% annualized total returns, which includes dividend and the capital appreciation. That sort of profile is what they have delivered in the last 6 years. Past returns do not guarantee future returns, right? But if you're interested in REITs, you can go and compare a lot of REITs. So in this video, I've spoken about total 5 assets that generate regular cash flow. And these 5 assets are not for everyone. You might decide to go with corporate bonds, for example, or somebody else might want to decide and they might want to go with IDCW mutual funds. It really depends on your risk appetite, your understanding of that asset class. This is extremely important. If you understand that asset class, then you invest in that. If you don't understand, please keep away from that so that your money is safe. That is the last bottom line I would leave you with, that please make sure you are doing safe investing. You are investing, you are understanding before you invest. If corporate bonds is what you want to consider, I've given you the link of Vint Wealth. You can go and look at Vint Wealth. I hope you enjoyed this video and learned something new. If you did, press the like button. Let me know in the comments a simple thank you. I will see you in my next video. Until then, keep rocking.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.